Hello Chasers! Today's episode is about the difference between repairs and improvements. I'm Chris Becks, your host, a business and financial advisor with over 40 years experience and the founder of the multi-award winning CBEX Business Solutions for Good. This is an accounting and tax topic. Therefore, as a member of CPA Australia and a registered tax agent, I'm obliged to give you this general advice disclaimer before we begin.
The advice provided is general advice only, as in preparing it, we did not take into account your investment objectives, financial situation, or particular needs. Before making an investment decision on the basis of this advice, you should consider how appropriate the advice is to your particular investment needs and objectives. You should also consider the tax implications on your financial situation. Chris Becks, CPA member number 805103 and registered tax agent number 629430015, is a director of CBEX Business Solutions for Good and is authorized to provide accounting and tax advice.
Now that is done, let's dive into this episode. The Australian Tax Office, or ATO, pays close attention to the expenses claimed by landlords, especially those operating in the Airbnb space. They are ramping up its enforcement activities and will undertake 4,500 audits of taxpayers it considers are high risk because they claim expenses incorrectly, overclaim, or don't declare income relating to rental properties. One area that is quite often misunderstood by landlords is the area of repairs and maintenance. They think that if they buy a house and decide it needs an internal paint job before they try and get a tenant, that they should be able to claim that painting expense as repairs and maintenance. This is a common mistake, and one quickly picked up by the ATO. But why is this not a repair? First things first, let's define repairs and improvements in the context of property maintenance. What are repairs and maintenance? The ATO advised that a repair is an expense that restores the efficiency of a function of the asset without changing its character, to maintain it in its original state. For example, you can fix defects or renew parts, but you can't totally reconstruct something. Repairs refer to fixing or replacing something that is damaged, broken, or worn out. These are actions taken to restore an item or a property to its original condition, ensuring it continues to function as intended. Repairs are typically necessary for regular wear and tear or unexpected damage caused by accidents or natural events. So what then are improvements? Almost by default, if an expense does not qualify as a repair, it will be an improvement. Improvements are handled differently by the ATO. The expenses incurred for making improvements to a property are considered capital in nature and cannot be claimed as an immediate deduction. Instead, these expenses are added to the property's cost base and can be used to reduce any capital gains tax liability when the property is eventually sold. For example, if you decided to renovate your investment property by adding a new room or installing a modern kitchen, the cost of these improvements is considered a capital improvement. These types of capital works can be partially claimed with a specialised depreciation report prepared by an appropriately qualified building practitioner approved by the ATO. When you sell the property in the future, you can factor in the cost of the renovations or improvements to determine the capital gain or loss for tax purposes. The trap with initial repairs. Property investors often feel the urge to carry out repairs and improvements on a newly purchased property before securing a tenant. While this might seem like a logical step to attract potential renters and maintain the property's condition, it's important to be mindful of the potential tax implications. The ATO has specific guidelines regarding repairs and improvements made to an investment property. Generally, repairs made before a tenant is secured may not be immediately tax deductible. The ATO considers the timing of repairs in relation to when the property is available for rent. To be eligible for tax deductions, the repairs must be directly related to the wear and tear or damage that occurred while the property was being rented or genuinely available for rent. This means that if repairs are carried out before the property is rented or available for rent, they may not be deductible as immediate expenses. For example, if you fix a broken window or repair a damaged roof right after purchasing the property but before a tenant moves in, those repair expenses may not be deductible until the property is genuinely available for rent. It's crucial to consult with a qualified tax professional or refer to the ATO guidelines to determine the specific eligibility of such repairs. What can you do to ensure you avoid this potential trap effectively? One strategy is to assess the property thoroughly before purchasing it. This allows you to identify any significant repairs or maintenance needs and factor them into your budget and negotiations. By addressing these issues before settlement, you might be able to negotiate a lower price to cover the works required and avoid the situation of carrying out repairs immediately after purchase. Another tip is to keep detailed records of all pre-tenancy repairs and improvements. This includes invoices, receipts, and any other relevant documentation such as contracts. While these expenses may not be immediately deductible, they can be added to the property's cost base and potentially reduce future capital gains tax liability when the property is sold. It is also important to note that once the property is genuinely available for rent and repairs are made during that period, those expenses are typically deductible as repairs. So, if you identify any maintenance or repairs needed after a tenant moves in, those costs can be claimed as tax deductions in the appropriate income year. Consider getting a special tax depreciation report. I mentioned earlier that a partial claim for capital works could be obtained with a specialised depreciation report. Depreciation is a tax deduction that allows property investors to account for the wear and tear or gradual deterioration of their investment property over time. Depreciation deductions can be claimed on both the building structure, capital works, and the plant and equipment assets within the property. A special tax depreciation report prepared by a quantity surveyor or architect can help property investors claim a depreciation deduction on the capital works. The government recently announced on budget night that from 7:30 p.m. on the 9th of March 2023, new build-to-rent projects will be eligible to claim an increase in the rate for capital works deductions from 2.5% to 4% per year. The tax depreciation report can only be prepared by a qualified professional trained in this area who are approved by the ATO to do this work, such as a quantity surveyor or architect, as accountants and real estate agents are not permitted to do so. It includes a thorough analysis of the building's construction and takes into account various factors such as the age of the property, the type of construction and the materials used. It also considers any renovations or improvements made to the property. It's important to note that not all properties are eligible for the 4% depreciation rate. The date of construction is a crucial factor in determining the depreciation rate. For properties constructed after the 15th of September 1987 up to budget night on the 9th of March 2023, the 2.5% rate per year over 40 years generally applies. However, for properties built before this date, different rates may be applicable, and it's necessary to consult the ATO guidelines or a qualified professional for accurate information. Claiming depreciation deductions through a tax depreciation report can significantly benefit property investors by reducing their taxable income and increasing their cash flow. It's a legitimate way to offset the costs associated with property ownership and maintenance. Understanding the difference between repairs and improvements, especially how the ATO treats them, is critical to avoid fines and penalties for incorrect tax returns. Repairs are immediately tax deductible, while improvements are considered capital and can be factored into capital gains tax calculations or partially claimed with a special tax depreciation report. Don't fall for the trap of claiming initial repairs carried out soon after purchase before a tenant is secured. Remember to consider the timing of repairs and seek professional advice to navigate the tax implications effectively. It's essential to keep in mind that tax laws and regulations are subject to change, so staying updated with the latest ATO guidelines is crucial. Engaging the services of a qualified quantity surveyor or architect ensures that you receive a comprehensive and accurate tax depreciation report, maximising your potential deductions while complying with the ATO requirements. Thank you for listening. I'm Chris Becks, and I look forward to presenting our next episode to you.
If you enjoyed this episode and you'd like to help support the Chasers channel, we would love you to share it with your business friends and colleagues, post about it on social media, or leave a rating and review. To catch all the latest from CBEX Business Solutions for Good, follow us on Facebook at facebook.com/CBEX, Instagram at CBEX, and on the internet at cbex.com. Thanks again, and we'll be sharing new info with you on our next episode.